Does higher buying power lead to greater risk? What do you think, Dad? Sponsored by the CBOE.
Yes. I mean, buying power is risk. So measured by the exchange, measured by the brokerage firm that's taking $1 in commission to take that risk above and beyond the buying power. So yes, would be my answer.
Do you think the buying power is a good reflection of the max risk?
Probably an overstatement of how much risk you have. Because for $1, how much risk are you going to take?
Very true.
I mean, look at an insurance company, how much they charge you per month on a vehicle when you haven't had, an accident in years. I mean, it's overstated.
Well, let's see. First slide, please. So buying power reduction is the capital a broker sets aside when you open a trade to cover potential losses. It's simply another way to measure a position's risk. For naked trades like strangles, buying power is roughly 20% of the stock price or the risk of a 2 standard deviation move. The risk-defined trades like an iron condor, buying power is much smaller, usually about 5 to 30% depending on the wing width. So when you're trading spreads, those are going to be cash secured versus strangles, which will have some sort of buying power relief. And that buying power can change based on a number of factors. It can be the status of the stock. So if it's a hard to borrow stock, you might see an increased buying power requirement on naked position. Volatility in that stock, when you see stocks that get above like 100% implied volatility, you'll see margin requirements expand as well there. It can also change broker to broker. So these can be internal risk parameters from broker to broker. So all those things kind of go into the buying power, but as a rough metric, about 20% of the notional value of that option is a rough estimate for the buying power requirement.
Good.
So currently the buying power for a 20 delta strangle is 5 times that of a $5 wide iron condor. Historically, the long-term average has been 4 times in the past 20 years. Does this mean that strangles carry at least 4 to 5 times more risk compared to similarly wide iron condors? And so what they're looking at here is the amount of risk you can put on in an iron condor versus just a single strangle here. So you're using the same amount of capital is basically what we're looking at here. And we're going to kind of look at the amount of realized risk that you have on these positions. These positions are using the same amount of capital. So it's going to be an example of how much risk is realized on both these. So to examine this, we tested selling 45-day options in 2 underlying. So we did SPY and Amazon. We compared 2 strategies. So we did the 20 delta strangle versus the 20-10 delta iron condor. So 20 delta short option, 10 delta for the long option on the iron condors. That'll take into account skew as well. And the 2 positions we managed holding to expiration versus closing at 21 days. We wanted to determine as a percentage of all losing trades, how many trades lost given fractions of their buying power. So we're looking at the buying power relative to the loss here.
Right, the buying power is going to be significantly less in the iron condor because it's the credit received minus the width. So let's say you're getting, $2.50 on this on a credit, you're going to get $7.50 in risk on the iron condor.
Very good. Next slide here. So when examining SPY options held to expiration, we saw that iron condors were more likely to have same level of losses compared to strangles. Also, the win rate for iron condors was lower. So when you're looking at obviously probabilities, you're going to have higher probability trades with just a strangle because you're not buying those wings. So your break even is going to be further away from the money. And you can see that here. SPY holding it to expiration of the losses as a percentage of the buying power. And when you weight these together, this is really where it comes into play, because if you're using a 1 contract strangle versus a 4 or 5 contract iron condor, and your percentage of the time that your losses are greater than 25% is 60%, you're taking some big losses on that versus the naked position, which theoretically has more risk to it. Like everybody gets caught up on the undefined.
Right.
It is technically undefined risk. We're kind of quantifying what undefined really means here.
Very good. Yeah. Again, we knew these percentages were going to be much greater on the iron condor. But look at the win rate. Win rate's pretty similar. I know 6 points is significant in a statistical world, but the win rate's pretty good for the amount of buying power if we're doing these 1-to-1 and not in your example 5, 7, 8, or 10-to-1.
Yes.
Very good.
Next one here
is up 14, by the way. Even the S&P is up 14. Sold off about 10 handles.
Silver moving too. Good.
Silver lower by a little over 2% now. $1.28 move, and gold down 54. All
futures still at 18. They've popped up about 10.
Market don't care right now.
Market say, who cares about this little dip? Managing positions at 21 days improves the performance of both strategies. However, iron condor still had a higher probability of losing the same level of P&L as a percentage of the buying power. So even when you're managing iron condor trades or managing any trades, anytime you're defining the risk, you're going to have a higher percentage of losing trades just because you're buying that risk. You're buying some sort of premium to define the risk, which is going to lower the probability and lower the speed of the trades. You're not, the winning trades don't move as fast as naked positions. There's always a gimme and a gotcha to quote our very own Dr. Jim, which has his last stop in Florida coming up this weekend. If you want to check it out.
That's right. Last of the live shows for the year.
Yes. So now looking at Amazon, so we found a similar pattern in Amazon when holding positions to expiration in terms of both loss percentages and win rates. So Amazon, we're looking at this just holding to expiration. The losses as a percentage of the buying power, 20 Delta Strangle versus the Iron Condors. Again, you see the win rate basically the same, but the percentage of time that you see losses are going to be a lot higher with iron condors, and that's just the nature of the trade here. And you can see that across the board when you're seeing, losses on both these trades, you're going to have them more frequently with iron condors.
Of course, that makes sense. It's interesting that the win rate's the same 6 vol differential between the two. I think it's just a coincidence, but probably works out to be like that if you were to do many stocks with good liquid markets to them.
Over time, the win rates and the probabilities tend to play out. So that's just the 6 points is the cost of buying the wings.
Correct.
That's the difference in the win rates. Next one here. So by managing at 21 days, the results improve significantly in both cases, and the gap between these two strategies becomes smaller. So when you're looking at individual equities that have kind of a binary nature to them, it might make sense to define the risk when you're looking at positions and managing them. Specifically, when you're managing them, when you're managing the trades, you're improving the iron condor positions there. After comparing these four, we can see that the risk is not actually lower for strangles. The higher buying power doesn't translate into higher risk in terms of the percentage of losses. So you can't just look at capital requirement like saying I'm risking $1,000 on this trade and risking $1,000 on this trade. They must be the same amount of risk. You have to keep in mind the probabilities, and with iron condors, you're cutting that down a little bit because you're buying some.
Even the S&P's up 8, getting a little soft here. Volatility down 18 cents.
Should have sold them at 68.50.
What was stopping you?
My paper hands.
Go to the takeaways.
Buying power can be an alternative measure for position risk. However, higher buying power does not necessarily equate to greater risks, especially regarding downside losses. While undefined risk trades have a much larger buying power than defined risk trades, many losing trades only lost a small fraction of their buying power with more variance between underlyings than between strikes. Exiting at 21 days can reduce exposure to large losses across various strategies. Not a shock. We've been talking about this for quite some time. Managing positions greatly reduces your P&L volatility. That's really the key here, is managing those positions.